Bom, vamos seguir então com o Macro Day 2025. I would like to invite to the stage Roger Ferguson, Executive Chairman of Andalusian Credit Partners and former Vice Chairman of the Board of Governors of the U.S. Federal Reserve System. E para moderar, eu convido de volta ao palco Tiago Berriel.
Hello, it's a great pleasure to have you here, Mr. Ferguson. I have a very short introduction of a very long CV here. Mr. Ferguson is the Stephen Tenenbaum Distinguished Fellow for International Economics at the Council of Foreign Relations. He's the immediate past president and CEO of TIAA. Mr. Ferguson is the former vice chairman of the Board of Governors of the Federal Reserve System. He's currently the CIO at the incubation firm Red Cell Partners, where he's also the chairman of the investment committee and a director. He's also the executive chairman of the Andalusian Credit Partners. He serves at the board of the Alphabet, Coring, and International Flavors and Fragrances. Mr. Ferguson holds a BA, a JD, and a PhD in economics, all from Harvard University. Thank you very much for being with us today.
Well, thank you very much for inviting me. I apologize that I do not speak Portuguese very well, so this will end up being in English. So.
Okay, that's great. So I'll start with a question on the implications of this very volatile months that we had this year in the global economy. We had tariffs, we have a lot of geopolitical uncertainty, we have a lot of tension in the relationship of the Federal Reserve and the President. Given all that, what do you think markets are pricing well all the risks? Do you think we are at the right point with the S&P 500 at high, a weak dollar, a very steep yield curve, and also all these volatile environment? What do you think are the effects to growth in the U.S. and globally?
Okay, well, it's a very complicated question with many components to it. First, as I think about the macro situation in the U.S., which is the major backdrop against which all these things are taking place, the U.S. economy is steadily growing, probably growing a little bit below trend. We've seen inflation, after it had been extremely elevated, gradually coming back down, but now looks like it's sort of roughly stuck at around 2.5%, 3%. We see in the U.S. economy a pretty stable labor market if measured by the unemployment rate, but some risk that things are weakening. And so it's sort of a mixed situation. And the Fed's most recent outlook, I would say, calls for, I'm going to coin a phrase, stagflation light. Still growing, but maybe below trend. Inflation elevated above the 2%, but not expanding dramatically. So that's part of the macro background. But the other thing that's going on that I think is driving some of the equity story is we're seeing a phenomenal explosion and I think correct degree of optimism around transformative technologies, call it AI as an example, and not just the AI engine itself, but the surrounding support infrastructure. And so when I look at the equity markets in the U.S., part of what I see is a very uneven market with AI, tech, financial services, all attracting a lot of capital domestically and internationally. But I see a number of other sectors where things are a little flatter. And so, that is sort of the configuration that I see. And then the final point vis-a-vis fixed income markets is there's really quite a demand for riskless assets. And that demand is, I think, starting to expand past just U.S. Treasuries to other assets that are available, including corporate debt, for example, and to some degree assets in other countries. So it's a very complicated story that I think is unfolding in front of our eyes here.
Great. So I'll try to dig a little bit deeper in a few of the overall aspects that you brought. On this, what's your view on this deceleration of the economic activity in the U.S.? There are so many things going on. Right. I mean, we have a fiscal policy that went from very stimulative to not that stimulative at all, and if you include the effect of tariffs, that could be actually a drag. We have all this uncertainty. We've had monetary policy on the contractionary side for a while. It seems that we have an exhaustion of this very strong consumption above the trend of income that we had after COVID and all the transfers that you had. And we also have some supply effects, right? Right. Immigration and things like that. Depending on, and actually even the data is giving us mixed signals, right? Labor market was strong, was revised to a very sharp decline, and then we still have some mixed signals in consumption. And the first, what do you think are the key aspects that we should be looking at, and what are the implications of these different aspects?
Well, look, I think you've touched on almost all of them. So first, it starts with a policy setting has been evolving in a way that's been sort of unpredictable. At the very, very early stage of the administration, there was a big question of, okay, we know the president is interested in imposing tariffs. What is the final tariff number going to be? And it migrated quite a bit, back and forth, up and down. I know from sitting on a number of boards that the one thing that CEOs don't like is uncertainty. And I think very early on there was a great deal of uncertainty about exactly where some of these policies would end up. We now have greater certainty about tariffs, but even there, we only have, frankly, some frameworks, a lot of negotiation for exceptions. And so I think one of the impacts of the tariffs uncertainty was slowing in some of the corporate decision-making. Then the tariffs themselves have been an imposition of a type of tax, and there's a question of who ultimately is going to pay for it. So we have all of that. I think the Fed monetary policy was only moderately stimulative. I wouldn't, moderately restrictive. There's some debate as to even how restrictive. So I wouldn't put too much weight on that. And then obviously immigration policy, which is continuing to evolve. It was focused early on illegal immigrants, probably relatively low-skilled people. We've now seen an unusual tax or price being associated with HB1 visas. And I think all of that also slows things down. So we have, I think, ultimately, out of the administration, a series of policies that have created uncertainty and have the risk of creating both inflation and stagnation. And I think that's causing some of the uncertainties that you're looking at.
Great. So before moving to the Fed, you mentioned you considered monetary policy not that restrictive at this point. I'd like to hear your thoughts on that. So you believe that, I know it's hard to have a measure of neutral rates, but related to your point, is as if we had a huge revision on the neutral rates for some reasons. And there might be some theories that might support that the neutral rate has gone up. One is that now we have this boom in investment coming from all this new technology, AI, things like that, and you're going to repeat the cycle that we had in the internet with very high investment, very high growth, low inflation, and very high real interest, higher interest rates. I'd like to hear what's behind this monetary policy being less restrictive.
All right, so you put your finger on this concept. I think all of you know the concept of the neutral rate. That's the rate that which monetary policy is neither stimulative nor restrictive, sometimes called R star. While it's a very important concept, it cannot be observed. No one knows exactly what R star is. And so, central banks sort of try to edge to it by looking to see how the economy itself is functioning. And, there are a number of observations that one could make that suggest that the policy has been somewhat restrictive. One is the economy certainly seems to be growing below potential. Now, we've already talked about the degree to which uncertainty around tariffs and uncertainty around tax policy and other things might be driving that, but certainly monetary policy probably is a little bit in the restrictive territory. But the other side of this is, while the labor market seems to be slowing, it's also roughly in balance at an unemployment rate, at least in the U.S., that's roughly close to full employment, maybe slightly elevated. We have equity markets that certainly don't look as though they're being restrained by monetary policy. And then the most recent reading we had on retail sales in the U.S., I think surprised people to the upside, showing consumers that are still resilient. Now, underneath all of that, on the consumer side, there's quite a bit of a tale of two cities between the average consumer, individuals making less than $175,000 a year in the U.S., which is roughly 80% of our population. They're feeling a little bit more stress, but the better off consumers are still doing well. So you put it all together, and while we can't observe this thing called the neutral rate, it does seem that policy is moderately restrictive, and consequently, what we saw is the Fed making a decision most recently to cut rates by 25 basis points, and Chairman Powell talking about moving away from being restrictive, maybe to closer to neutral. So ambiguity about what that number, that R star looks like, but a general sense that probably they are probably somewhat in restrictive territory, and they're in the process of gradually normalizing or correcting that.
So before moving to your views on the specific policy that the Fed will implement, I'd like to talk a little bit more on the conceptual side, right? I think we moved quite substantially away from the way monetary policy was determined before the pandemic to what we have now, right? The Fed seemed to have long plans, right? They were actually constructing a framework to have forward guidance and commitments that would take a while to develop and to change and to have these very long-term expectations affecting the economy today or at the present. And then we moved to the pandemic. We had all these shocks. We had a lot of inflation. We have a lot of volatility. And then we came to a very data-dependent framework where the current month data seems to have enormous weight on policy decisions and communication, and it seems to be exactly the opposite that we had before, actually the opposite of all the framework that we were trying to construct. As it is as if we had a very strong economic view beforehand that would shape the way monetary policy was being conducted, and now we just don't know anything, and we are driven by the currents.
So look, yes, you're right, and I think Chair Powell has explained this very well, which is there's a real absence of conviction around forecasts. And some of that has to do with recent experience. The Fed famously said, or infamously said, that the last bout of inflation they thought was transitory. That left them in a position where, when they changed their mind, they really had to catch up and move very, very quickly. And so I think they have decided to be much more cautious about weighing on forecasts. The other thing that's very interesting is if you look at the most recent set of what's called the dot plots of the summary of economic projections, there's a very wide dispersion among the 19 policymakers on some dispersion in the outlook, but a great dispersion on what the path of policy should be. And so it's really hard if you don't have a strong consensus among the policymakers to then say we're going to be guided by forecasts. You have very little trust in anyone's forecast, and the whole group doesn't have a consensus forecast that they can work off of. And so I think they're forced to this place of being more data dependent. There's a risk in that, which is they could fall behind the curve. I don't think that's been the case thus far, but certainly, it does leave them vulnerable. The other thing that being data dependent does, I've noticed, is it gets markets very focused on every piece of data. And is this the piece of data that's going to get the Fed to take the next cut? And maybe it's going to be a bigger cut because that data was particularly weak. And so, as an example, when there was this restatement of the labor market conditions, the expectation of a 50 basis point cut suddenly went way up. Not because the economy itself has changed dramatically, but because we had incoming data that was surprising to individuals. And so there's some risk to this data dependency, but I understand why they're there, because they don't have a high degree of confidence in their forecast. And frankly, the last time they took a strong point of view about the likely state of play on one of their major metrics, inflation, they frankly called it transitory when in fact it proved that it required more attention than they had originally planned.
I agree. There is a clear trade-off that you have to balance your view of the economy against the evidence in a very uncertain world, and that might introduce a lot of volatility. Just following up your comments on the SEP, in my view, the SEP was designed for the old framework, right? Where you were trying to shape expectations, where you had a view where the economy was going to go, when you were trying to build ways to communicate your forward guidance effectively. And it was almost like an instrument built for this low for long type of world. And now we stick with that. Nobody knows exactly where the rate's going to be. We have a lot of volatility, a lot of uncertainty, it seems, and a lot of movement from one meeting to the other, right? If you look at the previous SEP to this SEP, it's a huge change. What's the role of the SEP on this new framework? Is it introducing is it convenient? Should we change? Aren't we with a hammer and now we have to do a brain surgery?
All right, so let me, this is a conversation between central bankers. Let me bring everyone else into the discussion. So 4 times a year, all of the 19 policymakers on the FOMC present their own view of what the future is likely to be and what they think, based on their forecast, the best set of policy metrics should be. This was introduced a few years ago, and it was a big step forward because the Fed had never put forward from the policymakers any statement, any official statement about the future. And so this was a big effort towards being more transparent. What do you think the policy might be should the economy unfold in a certain way? And it was applauded as the Fed stepping forward and being more transparent. Now, to your point, there's a downside to all of this, which is it's not actually a formal forecast from the Fed. It's 19 separate individuals talking about what they think the right policy should be against the backdrop of their own forecasts. And so at this stage, I believe it is neutral. It is neither helpful nor harmful because of 2 things. One is people have observed that it's actually not necessarily a good forecaster of where the Fed is going to move. Secondly, most importantly, I think the chairman has worked really hard to downplay the reading of this so-called sort of dot plots by talking about how little confidence people have in it. And then the third thing, and here I do think the markets need to nuance this a little bit. I notice after every one of these 19 dot plots are released, or these 19 dots are released in the dot plot, the headlines say, oh, the Fed is promising, expecting, signaling. And what they're doing is they're looking at 9 or 10 out of the 19 and thinking, well, that's the median, but it's not the decision. And so one place where I think everyone needs to understand these so-called dot plots is you've got to look at all of them. and look at how uncertain things are and how there's lack of consensus. And so I think there's sort of the next step is for people to actually say, oh, there are 19 different statements being made. There's not a consensus. You know, in this most recent one, there is one person who said there probably shouldn't be any cut at the most recent meeting. There are 7 or 8 who thought maybe one more cut would be appropriate. There are 9 who think maybe 2 cuts would be appropriate. There's one who's expecting even more cuts. And so I think the next iteration of this is to move away from the Fed is projecting anything to saying there are 19 different voices and they're are scattered all over the place. So I think I wouldn't do away with it. I would encourage the market to read it more carefully and encourage journalists in the U.S. to write about it more carefully.
Yeah. My experience at the central bank is that whenever we try to communicate, to make people understand well something that is complicated, it's very hard, but you should try. Yeah.
I think we should try, but the market also has to understand that this is a group of policymakers who have some of the best models of their economies. The U.S., the Fed's model of the U.S. economy is very good, but it doesn't mean that it's perfect.
Sure.
And at the end of the day, you have to respond to the actual economy, not to the model. And so getting people to understand that this is a series of people doing their best, but no decisions are made until they get into the room because they want to see the most recent data and the most recent forecast. So some of this has to be how people consume. It's not just what the Fed says, but it's also people becoming more intelligent consumers of what the Fed says. Perfect. And you know, if you think about your own life, you may have an expectation of something that you're going to do, but it's not a 100% guarantee until the moment actually occurs. And monetary policy is no different. You may have an expectation of what you might do at the next meeting, but until the meeting has occurred, you haven't actually made that decision.
So perfect. So let's go to what really matters. So what the Fed should do, how should we react to all this uncertainty, how to balance these somewhat clear deceleration with mixed signals, weaker labor market, an overall economy that doesn't show the same degree of weakness that in the labor market, but still a somewhat high inflation and very loose financial conditions. So my question is, how fast should they go? How deep should they go? Knowing what we know at this point, right?
Look, I think knowing what we know at this point, the Fed made what is on balance the right decision the last time around. And I would say they need to leave themselves a lot of flexibility to decide the answer to the question. You know, until we know, how transitory this, if it is, this inflation, this stubborn inflation is going to be, I think it's a little hard for them to say, how far they want to go. Until they get a better understanding of the labor market. The labor market is complex right now. We have immigration issues that are perhaps driving down supply. We have a slowing economy that's driving down demand for labor. And so I think the answer to your question is the fair one that Chair Powell gave, which is when asked about the market that was pricing in 2 more cuts, he observed that the market was pricing those cuts without endorsing that as a view. And I think that's the best he can say, which is the market expects a couple more cuts. That's the way they see the economy. We're mindful of that. We're not yet endorsing that view. And we'll get and see. The other thing he said that I think people really need to listen to is there are no risk-free choices for the Fed right now. And if you think about how you deal with your life, if there are no risk-free choices, you're very cautious. If every move has risk associated with it, you're likely to move much more slowly and likely to wait for more information. So I wouldn't be surprised to see the Fed moving maybe more slowly than markets expect, because I think that's the way human beings react, because inflation is still running above its target. They don't want to lose inflation credibility. And the labor market, as you point out, is sending a number of mixed signals. And as you point out, financial conditions are quite accommodative. And so that strikes me as a signal for a cautious Fed. They may end up making 2 more cuts this year, But I don't think that's baked into the cake just yet, and I think they're prudent to wait and see and make decisions from meeting to meeting.
Okay, I'll insist a little bit, but the risks for the Fed have changed quite a bit in the last 2 months, right? They had these two goals: inflation at the target and full employment and the labor market doing well. And Chairman Powell was very transparent in the way he was thinking about it. He said, look, we have a shock that is usually a one-off type of shock to the price level, tariffs. One should not react to these first-order effects, the direct effects of tariffs on inflation, but a central banker should be worried about second-round effects, right? The effects that these tariffs has on the overall price level or inflation expectations or the inflation dynamics for the future, right? And he said, look, we are in a great place to wait because we have a very balanced labor market. And then he learned that, well, maybe the labor market is not that balanced, or at least we have some evidence now that despite the fact that we have a supply shock, we have less immigration, the effect on the demand side seems to be stronger. We have some easing, right? And then things have changed, right? You have two things. One of your goals is at risk. It's full employment is at risk. And the other one, the risk of a second round effect of the tariff shock on overall prices or inflation expectations is less intense, right? Because now you have a somewhat weaker economic activity overall and some more slack on the labor market. Mm-hmm. Then isn't it risky to keep at a restrictive level at this point? Shouldn't it converge closer to? And usually when you start this easing process in the labor market, it can be intense, right?
Well, look, so that is exactly the argument that supported this most recent move. You know, you said it very, very well, which is we see some inflation right now. We don't know if it's going to continue indefinitely. Maybe it's one-off, but against a backdrop in which we've had a surprising amount of inflation over the last several years. The flip side is short-term inflation expectations seem to be rising, but long-term inflation expectations are stable. And so that gave him, and the committee, with one exception, everyone voted for a 25 basis point move for exactly the point that you made. Having said that, let's wait and every meeting will be a live meeting, and then they will decide. But I think it would have been unwise for them to move more quickly this time, given that we don't know how restrictive policy is. As you say, the financial conditions are still pretty accommodative. And so I think they balanced this very, very well and came to the right conclusion. I think had they done more than that, it would have been a signal of maybe deeper concern about the strength of the U.S. economy than they actually have. And it might also have had some people think that maybe they aren't as focused on the inflation risk, as they should be. And so I give them high marks for making the right decision at the moment, but leaving the future decisions to be made in the future. I think that's the only wise thing to do at this stage.
Great. Another question on monetary policy. On the tightening cycle, on the way up, I think a lot of people were surprised on how lagged were the negative effects on economic activity of the easing cycle, right? Mm-hmm. And then a lot of people start thinking about, well, what's going on? This time, the effects of the tightening of monetary policy is taking that long. And there are some good reasons to have these lagged effects, right? Firms and families have locked in fixed rate long-term debt, and so all the effects on disposable income or the cash flow of companies were very limited of these interest rate hikes. Only at the margin they were effective, and then we had to wait a little bit to see the effects. should we expect something similar on the way down? Or I don't think so, right? I think there's a lot going on in terms of balance sheet of families and firms that, and actually a lot of tappable equity in housing that could lead to reverse mortgages that we might find ourselves way more sensitive on the way down than we were in the way up. But I'd like to hear your thoughts on that.
I think it's a great question. And let me share some thoughts without necessarily agreeing with your theory. There are a number of transmission mechanisms for monetary policy. Some of them move more rapidly than others. As you point out, in the United States, for the individuals, our mortgages tend to be 30-year fixed mortgages. And so you don't see much impact on housing valuations right away or on the wealth effect for individuals right away. Second way that monetary policy is transmitted in the U.S. is through broader financial conditions, which are already really quite strong. That might change dramatically if the Fed didn't continue to cut. The markets would have a very different expectation, and you would see a pretty rapid transmission that way, for sure. The third that we haven't talked about much is through the exchange rate. And we've already seen exchange rates in the United States for the dollar come down quite a bit, i.e. markets are expecting, there are a number of things going on there, but one of them is markets are already expecting some reduction. And so I think to some degree, we've already seen some of the effect of an expectation of an easing cycle already, which might be one of the reasons why the slowing is only moderate. And so I think we have to really think through each one of these transmission mechanisms and the fact that there's such an expectation channel that's built up that might be driving some of this. And I therefore am not so, it may be that we've already seen some of the effect and the rest of the effect may come more slowly. And so it's a much more complicated story about transmission and pace of transmission on the way down than it was on the way up. Does that make sense?
Yeah.
That makes sense?
No, I agree with you. There's this expectation channel that might be operative right now, like exchange rate and things like that. But I think there's still a lot that is really mechanical.
Yes.
Look at the housing market and all the mortgages and reverse mortgages and the amount of tappable equity that they have there. That should be a support for consumption.
I think it should be. Absolutely.
Yeah,
No, we're agreeing.
Yeah. So, moving more to your current role, I'd like to hear your thoughts on the credit and public credit market. Mostly, how can we explain all these spread compression in a situation of deceleration, still very high interest rates, and everything that's going? Seems for me, for an economist, a little bit counterintuitive, but maybe you have a more.
Oh, look, I think on credit markets, there's no such thing as a credit market in the United States. We have credit markets that still run through banks. We have consumer credit that we've talked about. And then in the private credit market, there's really quite a dispersion across private credit markets. So I am the executive chairman of Andalusian Credit. We focus in on middle market companies that don't have access to banks or frankly don't have access to the really big marquee names in the credit space. Those companies that have raised 10, 15, 20 billion dollars for private credit. That's quite different. They deal with the larger companies, they deal with so-called sponsors, i.e. PE firms, et cetera. They have to write much bigger checks. In that market, you have seen quite a compression because there's so much capital that's gone into that market, and it really has to be put to work. At the company that I'm associated with, Andalusian Credit, we've put roughly $1 billion to work. When we put leverage on, it'll be a bit more. We are focused on smaller and middle-sized companies. That market, you haven't seen the kinds of compression that you're talking about. We still have strong covenants. And so I think the main thing to recognize is you can't generalize about credit markets in the U.S. because it's such a varied group from middle market and even smaller companies to pretty large companies, from smaller firms that do fundamental underwriting that aren't so focused on the so-called sponsored market, goes directly to the borrowers versus other companies. And so this really is a tale of many different cities. And for the larger companies, this compression has taken place because there's so much capital that's got to be put to work. For smaller companies and middle market companies, we aren't seeing nearly that kind of compression. We're still seeing very good covenants. And that is because we had the chance to really do much deeper underwriting.
What's our expectation for this market with this deceleration and easing cycle? How will it be affected?
Look, I think I give the same story, which is for the bigger companies that are very, very interest sensitive and have to put money to work, they have to put money to work almost whatever the price of money is. And so I'd expect for them, as interest rates decline, that the spreads for them will still tighten. I don't think that's going to be true for the kinds of companies I work with, that we lend to, because they don't have access to all these other channels, so to speak. And so, and it goes back a little bit to your point about the pace at which an easing cycle plays through the economy. Some areas that are, quote, credit sensitive or interest rate sensitive are less sensitive than others because it depends very much on individual supply-demand dynamics in different parts of the market.
Great. So let's move to a very popular topic right now, which is the institutional issues that the Fed has been experiencing these days. It's quite an unprecedented moment here where the president is being very vocal in his critics to the Fed. He actually fired a board member.
Well, he attempted to fire.
Attempted to fire. No,
Still,
he
still
fired,
being litigated.
But I mean, he fired, but it didn't go through yet. And he has constantly and very heavily and very specifically criticizing the chairman, Chair Powell. He appointed someone to the board that is very close to the White House. So there are a few things that we wonder might be the consequences of that. So let's start with, do you think markets are pricing well the risks associated with this type of intervention? And then start for that, and then we...
All right, well, let me get to your question, but first let me give you some historical context, because anyone who's been a central banker understands that the executive branch, the president, people around the president, have been consistently, pushing central banks throughout history to, generally speaking, to lower rates. I've never run into someone from the executive branch who wants rates higher. And so that's happened quite a bit in the United States as well. I mean, the first thing you have to understand is during the course of the Second World War, the Fed was not at all independent. Their job was to keep rates low so that the United States could borrow money to fund the war effort. The Fed only became independent with an accord in 1951. And since then, what has normally happened, what has often happened, is presidents have quietly jawboned the central bank to reduce rates. This happened with Lyndon Johnson, who called in William McChesney Martin. It most famously happened with Richard Nixon, who put a lot of pressure on Arthur Burns to keep rates low when Nixon was running for reappointment, and Burns acceded to that, which is one of the things that kicked off the round of inflation in the United States. Ronald Reagan famously called in chairs to encourage them to reduce rates. That stopped under Clinton in particular, Bush II, Obama, Biden tended to avoid that kind of thing. So the first message is not unusual for there to be pressure on the Fed. Second message is highly unusual to have this kind of very public pressure on the Fed. And as you point out, to have an individual appointed to the Fed who's only on leave of absence from the White House. So that is unprecedented, this degree of public pressure and that particular link between the White House and the Fed. No one knows quite where this is going to end yet.
And very public and specific suggestions on how to conduct monetary policy.
All of that is brand new, okay? Now, a couple of things. We've certainly seen Chair Powell, when asked about it, just to ignore it and move on, okay? So he didn't take the bait. He didn't decide to argue with the president. They've worked really hard to have their decisions being driven by the incoming data and by economics, not by politics. So now you've raised the biggest question, which is the president has attempted to fire a member of the Board of Governors, unprecedented. The law does say that a member of the board can be removed for cause, but no one knows quite what that set of words, those two words mean. And so we're now going through the court case. We will see what happens. I know there's going to be a lot of interest on this. The Supreme Court in the United States hinted, it didn't decide, but it hinted that maybe the Fed is different and the notion of for cause is a much higher hurdle, but it's not yet proven. And so we'll watch all of this. To your last question, I think markets have not priced in any of the risk to the Fed's independence. My hypothesis is that the markets believe that the Fed's independence is so critically important that the courts will back it up. And so I think another way to think about this is markets are pricing in a status quo kind of outcome with the independence of the Fed and the board members being reinforced and upheld by the courts. So it may be just the opposite. It may be not that they're ignoring it, that they're taking a point of view. And then we'll see if they prove to be right.
Okay, let me try to break the question in a few points. There's this short-term influence that the president can have at the board that could be backed by courts and provide some independence, right? There's one question there. I mean, that this type of pressure happens everywhere.
Right.
The U.S., but in emerging countries more often. And sometimes in a few countries, I'm not talking about Brazil here, this type of public pressure makes the central banks a little bit more on the conservative side. And in my opinion, that kind of makes sense, right? If a central bank is an institution where credibility for emerging economies is not always, but sometimes the case, where credibility is not 100% settled, and you have a president pushing you, maybe in order to preserve the credibility and have a better long-term trade-off to monetary policy, it's better to take risks on the conservative side. Do we risk on this short term the Fed to take this approach in order to make sure credibility is there? I'll look a little bit tougher than I would do in order to preserve the idea of independence to the markets. That's something that actually happens a lot. That's the first one. The second one is that one thing is the short-term independence backed by courts and things like that. The second is the president has the choice of the future board, and he can appoint board members that would take the president's opinion into consideration in order to execute monetary policy, and that's a way to get rid of independence de facto, even not by the jure. So your views on that?
Let me speak to three separate points. The first one you said by implication, but let me make it more explicit. Because the world has had experience with central banks that are heavily politicized, the general theme around the world has become independent central banks, right? And that was not always the case, but over the last 20 or 30 years, emerging markets, developed world, whatever you may, the vast majority of central banks, the vast majority of people think it is better for central banks to be independent. And the examples where that is not the case are probably the examples where we've had more inflation risk and hyperinflation risk. So that's point one. So this independence is not just sort of a U.S. thing, it's a global thing. Point two, my observation at least is, while monetary policy makers, we hate to admit it, are human, most of them, I would hope and expect, make their decisions independent of the pressure one way or the other. And the reason is, and this will go to your third question as well, the decisions that central banks make have a direct, maybe over time, influence on both growth, inflation, et cetera, whatever your mandate might be. And most central banks that I know, unless they are central bankers that I know, some of them are more political than others, but if they're wise, they want to be worried about their legacy. At least certainly in the United States, I can speak there. The fact that Arthur Burns gave in to Nixon's pressure has really become a critical way that central banks in the U.S. think about this, and no one wants to be caught off in an Arthur Burns kind of legacy. That takes me to your last question, which is, yes, you should be aware that over time, President Trump or any president will be able to put more board members on. Right now, there are 3 of the board members that President Trump has nominated either this first term or this term. He will have a chance to nominate a successor to Jay Powell. It's unlikely to be Jay Powell. There are other names. Having said that, the central bank optimist, institutionalist in me says that once people sit at that chair, sit around that table, and decide that their votes will have a big impact on millions of Americans, inflation, growth expectations, financial stability, et cetera, the particular desires of the president who appoints them will not have undue weight. One has to remember that Jay Powell was appointed by President Trump, and President Trump has persistently said it was a terrible mistake because Jay Powell has proven to be, quite independent. So we'll look and see. But having sat at that table for nearly a decade, the weight of doing it right is much more important than the weight of who it was who happens to have nominated you. Now, I had the good fortune of being nominated by both a Democrat and a Republican, so I could be sort of straight down the middle on this. But presidents always want lower interest rates, and the job of the Fed is the only institution by law that has to keep inflation under control. And that should, play a much heavier burden than who it was who happened to have nominated you. So, but we'll see, but count me a cautious optimist.
So just insisting a little bit. So do you think it makes sense to be more conservative in the way you conduct monetary policy when the environment is the one of a lot of pressure from the executive branch in order to preserve credibility, in order to preserve this long-term trade-off, efficient trade-off in monetary policy?
Yeah. No, I understand your question. So look, the answer is, I think, no, as in being bullish about keeping interest rates high just because someone wants you to make them low is no better, in my judgment, than reducing rates because someone wants to make them low. I think a good central banker has to do what they say they're doing, looking at the incoming data, thinking about the risks, thinking about forecasts, all that range of things. None of them say I should be listening and reacting favorably or in opposition to whatever it is that the administration may run. Because there's a cost to being too tight as well. And the goal is to keep things growing at maximum sustainable growth and inflation under control. It's not slowing things down just to thwart what the president has asked you to do.
Perfect. So we still have a few minutes. Let's move to the fiscal policy in the U.S. and all the implications, all the problems that we see there. So there's a question on how are we going to do this adjustment, right? We have a debt dynamics that doesn't seem to be favorable. We have a nominal deficit that's around 7% of GDP, and we don't see a clear way forward or adjustment that would drive it to around 3 or 4. It's not on the radar. So the first question is, how do you see this adjustment? And the second, what are the implications of that dynamics? Are we close to a point where this is going to become dysfunctional and we can get some really tough market punishment?
So look, let me try the second question first, which is how close are we to the markets really being concerned about the U.S. fiscal situation and therefore unwilling to buy our debt? We've seen a few Treasury auctions that were, I'd say, a little rough, we'll put it that way. But we always managed to sell all of our debt at reasonable interest rates. And I think that's a reflection that the markets, in two ways in the markets. First, the U.S. Treasury market is the only one that's deep, liquid, et cetera, et cetera. It's associated with a country that still has very strong institutional credibility. The second thing that's going on here that is really important, and we don't have the answer to the second thing just yet, is there's quite a pool of global savings that's looking for investable opportunities. And the U.S. Treasury market is one of the few that has withstood the test of time. And so I think we really, I don't want to be overly optimistic, but I don't think we're getting that close to that inflection point just yet. To your first question on how we fix this, I think it's going to take a lot more backbone than many people have right now, because we actually are going to have to, over time, both reduce expenses and raise taxes. The optimistic story is that the AI revolution will lead to a much more productive economy. To some degree, the last time we had a balanced budget in the U.S., it was in part driven by the so-called peace dividend, but it was in part driven by a much stronger economy than we had expected. So there's a little bit of optimism there. I would not put too much of my weight on the optimistic story, that I think we'll see some impact of improved productivity. So look, the U.S. is eventually going to have to come to grips with this. Now, having been a U.S. citizen and lived in the U.S. my entire life, the last thing that people are comfortable doing is talking about the inevitability of reducing expenses and raising taxes. So I'm not an elected official. I think it is inevitable. But like everything else in the U.S., we'll delay it to the last possible moment. So I don't expect that's going to fix itself in the next election cycle, to put it mildly.
So more on the evidence that there is something going on the fiscal side is that recently, not only in the U.S., but actually across developed economies, we have seen an increasing term premium on the yield curve. And then, there has some people associated that with the fiscal side. That seems to be the case. And that actually can be a game changer for monetary policy and actually to the fiscal dynamics going forward. That's something that we are always very worried about in emerging economies. And it seems to be completely absent of any discussion in developed economies in the U.S., and in recent months it's coming. How do you see this as a restriction to, or influence to monetary policy, right? Because financial conditions will be tighter if you have a term premium that is high enough. And monetary policy has to take this into account in order to react.
Absolutely, but so it's a very complex dynamic, right? Because if term premiums start to rise at the long end of the yield curve, it will certainly tighten fiscal conditions, as you point out. One might argue that means easier policy, but it plays into this dynamic of easier policy, increased inflation expectations. Consequently, the long end of the yield curve continues to rise. And so I think the only answer is the Fed needs to control what it can control, short end of the yield curve, focus on inflation, and the long end will send market signals back to both fiscal and monetary authorities about the need to get their house in order. And one of the things that's very interesting is the reason President Trump is pushing for lower interest rates is he wants to be able to fund the U.S. debt at a lower long-term interest rate. You and I both understand the dynamic may not work the way that he wants, and so in order for this to actually work the way he wants, he's got to create a credible story about our ability to continue to run this fiscal system in a way that's much more balanced. And so at the end of the day, the pressure is going to go back on the fiscal authorities before it is on monetary authorities to respond to the long end of the yield curve, because it's, after all, the administration's obligation to fund the U.S. debt at a reasonable cost. It's not the job of it was many years ago. It's not currently the job of the central bank. And so, I think the way this is going to work, I hope the way it works, is more discipline in Congress and the administration to create a better fiscal situation, to free the Fed to do what it's supposed to do, which is focus on short-term rates, inflation, and unemployment.
Great. We are running out of time. Mr. Ferguson, it was an excellent conversation. It was a pleasure. Hopefully we can repeat that soon. Thank you very much.
Thank you very much. Happy to come back. Thank you.